IML students? Today you guys are going to learn about the major players in the Forex market, the market participants. Now, why is it important for you to understand who you're up against? So that way you can strategize, right? Okay, so that's what we're going to be talking about today. Get out your pens, get out your papers, pause the video, make sure you take good notes, know who your opponent is so that you can strategize, ultimately giving you the best probability of the best profits. Before we get started, here's a little bit about myself. My name is Adeze Duncan, representing iMarkets Live. Some of you may know me from Forex 101 on IML TV. Also, I was an educator for 10 years, and now I'm here educating you on the facts and methods of Forex. In order to get started on this journey, you need to remember one thing and one thing only. I am a student, always. This is very important for you to remember and to remind yourself of often. You will hear me use this phrase frequently as a reminder that you are a student that is learning a skill that will pay you for the rest of your life. Make sure that you take your time and learn what you need to learn. Pace yourself. Do not compare yourself to anyone else's progress. Always keep a winning mind frame, and you will do very well in this industry. Upon finishing this video, you should have a very good understanding of the following questions. Read through them quietly to yourself. As you are taking notes, make sure to pause this video in order to answer these questions. Now let's get on to the major market participants. It is important to know who the major market participants are in the Forex market because these market participants are what causes the currency prices to move. They are the ones who make the trade setups, and over 80% of the Forex market volume transactions are done by them. Retail traders, which I will talk about soon, are responsible for less than 20% of the transactions, and honestly, in general, whatever the retail traders do barely has any kind of real impact on the movement of prices. So who are some of the biggest stakeholders in the Forex market? Let's start with the central banks and the government. The central banks are some of the most influential players in the Forex market. The central bank's monetary policy generally outlines the particular country's vision for growth, how they are tackling issues like inflation, deflation, and their position on interest rates. It is very important to know what the central bank's position is on interest rates because this is what determines the money supply for the country and its currency rate globally. So when you decide to trade the news, you want to make sure to pay close attention to any high impact news that has to do with the interest rates, such as FOMC, central bank rate decision, the GDP, the CPI, and the unemployment rate. Unlike retail traders, central banks don't trade to make a profit. Imagine that. They have different purposes for what they do in the Forex market. For example, the Bank of Japan has to keep the value of the Japanese yen low because the Japanese economy is dependent on the export of Japanese products. And other countries won't want to order from Japan if their products are too expensive. So when the yen value goes up, the Japanese bank buys other countries' currencies against the yen in order to lower the yen's value. As you see, this has nothing to do with making a profit because in this case they will have taken a significant loss. This is just one example of how central banks play a role in the government's monetary goals for that particular country. Another major player are banks and financial institutions. Banks are involved in foreign exchange transactions for many reasons, whether it's for business transactions or for personal use. They deal with a large amount of foreign exchange at any time. One of the main players is the interbank market. The interbank market is made up of the major banks that you and I both know well, such as US Bank, Wells Fargo, JP Morgan, Barclay, USBC, to name a few. These are the players that provide the most volume that causes the market to move the way it does. It's very important for you to understand this because during major holidays and certain seasons, such as the summer, the market does not behave normally, and this is not always the best time to trade. This is because the interbank markets go on holiday vacation. With such major player out of the market, you will not see as many huge shifts and movements that cause the market to trend or keeps the momentum moving. As a result, this is the worst time to try and trade. In other words, when they go on vacation, you need to go on vacation as well. Use that time to dig deep into IML's educational tools, fine-tune your trading plan, backtest your strategies. Some of these major holidays, including Christmas, Thanksgiving, Easter, and New Year's, Really, basically any major bank holiday for that country's bank. If there's a major bank holiday in Japan, then don't trade the yen pairs for that day. If there's a major holiday in the UK, then don't trade any of the GBPs or the euro pairs for that day. Similarly, in the US, if there's a major holiday, then stay away from USD pairs. Another major market player are hedgers or hedge funds. Any major corporation or company will deal with hedgers. It is the hedger's job to protect the companies from major losses of money while doing foreign trade. For example, if a company wants to start a project that can take a few years to order some of the pieces now, they might be able to get those parts for one price. But in a year's time, that price may have risen if they need to order more parts later. It is the hedger's job to create a contract which will allow companies to purchase parts at an agreed upon price for later in order to save the money now over the long run. These companies allow large corporations to do foreign trade with other countries by exchanging their money for the foreign currencies in order to do business in that particular country in the future. Next, you have the speculators. They play a major role in predicting trends in attempts to profit. They are sophisticated risk-taking investors with expertise in the markets in which they are trading. Notice I said expertise in the markets that they are trading. Too many people want to come into the Forex market and trade 50 different pairs. Stick to a few, become an expert at those particular markets. These investors are called speculators due to their tendency to attempt to predict price changes in more volatile sections of the market. This is a lot easier to do when you are when you're an expert of just a few markets. These investors are called speculators due to their tendency to attempt to predict price changes in more volatile sections of the markets, believing or speculating that a high profit will occur even if the market indicators may suggest otherwise. If a speculator believes that a particular asset is going to increase in value, they may choose to purchase as much of the asset as possible. This activity drives up the price of the particular asset. The same can be seen in reverse. So what exactly do I mean drive up the prices? Well, if you look right here in this market here, the arrows that are red are showing areas where the market moved up significantly. This is because through supply and demand, as they started to buy more of the assets, those assets started to move up, the value of those assets started to move up. So that is why you see major shifts upwards. And contrarily, the green arrows that are pointing downwards are showing you where they sold off a lot of their assets, and as a result, they lowered the value due to supply and demand. Some of the most famous speculators that you may have heard of is George Soros. He went short on the pound, earning him his first $1 billion in less than 1 month. By the way, when I say went short, I'm saying he sold off his part in the pound. Okay. And then you might know of somebody else named Nick Leeson, who was a trader with the Barings Bank in England. As a result of his incorrect speculations for the yen, he lost over $1 billion, which resulted in the collapse of the company. Speculators work for major banks and special departments and trade money for clients. It is these departments that take your hard-earned money that you take to the bank, put it in the Forex market, and then grow it and turn around, pay you a whopping 1% for the year. Isn't that great? So also you notice that these guys work for the bank. That also means that when the bank is on vacation, they are on vacation. You are missing a huge portion of players that move the market. So again, when they go on vacation, you go on vacation. Finally, another very important market participant are the retail traders or independent investors, which, as I talked about earlier, comprise only 20% of the market's overall movement. Whoop-de-doo-doo. Investing in FX used to be the exclusive privilege of an elite group of hedge funds, investment banks, and multinational corporations. These institutions guarded their turf fiercely. And why not? Between 1990 and 2006, Forex investments returned 9% a year, more than either bonds or equities over the same period. For individual investors, the Forex has largely been off limits. One needed a minimum of $1 million to place a trade, and there were a plethora of complex legal documents to review and sign, as well as an extensive credit check. Now, over the past 10 years, this has all changed. Thanks to the internet, online trading systems which give ordinary investors direct access to the currency markets is now possible for retail investment communities such as us to easily and quickly trade on international forex markets from any internet-capable computer. That means you can be anywhere in the world as long as you've got internet, you can trade. So retail traders include people who do not trade for companies, again, like you and I, who also use risk management strategies in hopes of personal gains, and they do not have a major role in deciding the trend. It is very important to know that retail investors like us are at the bottom of the totem pole in this forex market. Many people come into the forex market thinking that they can predict the market and what it's going to do. Let me tell you right now, you will not be able to predict this market. Your job is to find the trends that arise and follow them closely. Get ahead of them, get underneath them, but do not try to predict the markets. By now, you should have a good understanding of the following questions. Read them quietly to yourself, answer them, and when you are finished, go on to the next video in Forex Foundation 1 series. My name is Adeze Duncan, and remember, I am a student always.